Hello, everybody. At this time, we are talking about cash management. Cash management is the collecting and managing of cash flows, which is important for individuals and companies. Cash is a key component of a company's financial stability and a part of an individual's wealth portfolio. Many cash management solutions from banks and financial institutions are available for individuals and businesses. And then we move to the importance of cash. Cash is the primary asset individuals and companies use regularly to settle their debt obligations and operating expenses like taxes, employee salaries, inventory purchases, advertising costs, rents, etc. Cash is used as investment capital to be allocated to long-term assets such as property, plant and equipment, and other non-current assets. Excess cash after accounting for expenses often goes towards dividends distributions. Companies with a multitude of cash inflows and outflows must be properly managed to maintain adequate business stability. For individuals, maintaining cash balances is also a major concern. And then we move to objectives of cash management. The key objectives of cash flow management include first, optimizing cash flow, ensuring enough cash is available for daily operations while avoiding excessive idle cash that could have been invested elsewhere. And second, enhancing profitability. By managing cash efficiently, businesses can increase returns on investment and reduce the risk of insolvency. And then third, minimizing costs. Reducing unnecessary fees and interest expenses by managing cash more efficiently. Fourth, forecasting cash flow. Predicting future cash requirements helps business plan for growth and emergencies. And fifth, maintaining liquidity. Ensuring that the business has enough cash or assets to meet immediate and long-term financial obligations without borrowing. And then we move to advantages of cash management services. Cash management services offer a range of advantages for both businesses and individuals. There are some key benefits to consider. The first, data-driven forecasting and planning. With robust cash management, businesses can make highly accurate predictions on future expenses and profit and make plans accordingly. And second, simplified compliance. Cash management services can offer tools and reports that simplify the process of adhering to financial regulations. This can be a significant benefit for businesses that operate in complex regulatory environments. And then third, enhance control and visibility. Cash management tools give visibility into where money is coming from and going, identify areas for improvement, and make informed decisions about spending and saving. And then move to the types of cash management. There are some of the different types of cash management. The first, cash flow from operating activities. The cash flow statement of an organization will show cash flow from operating activities, including cash flow from investing. And then second, free cash flow to equity. After capital has been reinvested, cash is still available, known as free cash flow to equity. And then the third, free flow to the firm. This metric is utilized in financial modeling and valuation. And then fourth, net change in cash. The term net change in cash describes the overall cash flow change from one accounting period to the next. And then what functions of cash management? The first function, inventory management. Effective inventory management helps clear block sales, reduce excess stock, and improve liquidity. By managing funds efficiently, companies can sell existing inventory, ensuring steady cash inflow. And then second, short-term investment. Cash management aims to prevent cash shortage and insolvency. Surplus cash can be invested in short-term instruments like government securities to enhance value. And then third, payables management. Payables are liabilities incurred when purchasing on credit. Effective fund management ensures timely repayment of loans and credit purchases, avoiding penalties and interest charges. And then fourth, receivables management. After a credit sale, a company records the sale, but payment is often pending. Cash management ensures timely collection of receivables, maintaining adequate liquid cash. And then we move to causes of problems with cash management. Problems with cash management can arise from various sources. The first source, poor forecasting. Inaccurate cash flow projections can lead to either excess cash or insufficient funds to meet obligations. And then second, invariable mismanagement. Having excess inventory ties up cash unnecessarily. Poor inventory management can lead to cash shortage and missed business opportunities. And then third, inefficient collections. Delays in collecting payments from clients or customers can lead to cash shortage. And then fourth, high operating costs. Uncontrolled spending or poor cost management can lead to cash deficits. And then fifth, excessive credit. Extending too much credit to customers without appropriate monitoring can strain cash flow. I think it is enough. Thanks for watching.